Hi everyone, good morning. This is Peter Magbanwa from Group 7. Together with my partner Joey and Ituralba, we are going to present to you our report about working capital management. Our goal for today's discussion is to learn about cash conversion cycle, cash budget, credit policy, and trade credit. So for today, I'll be presenting with you the first part, which is the cash conversion cycle and the cash budget. And the other portions will be reported by my partner, Joey and Ituraba. So now let's start with the basic concepts about working capital management. The question is, what is working capital management? Working capital management is actually a tool that helps organizations effectively use current assets and helping companies maintain sufficient cash flow to meet short term goals and obligations. So basically, the main purpose of working capital management is to enable the company to maintain sufficient cash flow to meet its short term operation costs and short term debt obligations. So, a company's working capital is made up of its current assets minus its current liabilities. The key term here is to making sure that we have sufficient cash to meet our short term obligations, such as the operating cost and the short term debt obligation. Working capital management helps maintain the smooth operation of net operating cycle, also known as the cash conversion cycle. Later on, I'll introduce to you what's cash operating cycle. Working capital management can improve companies' earnings and profitability through efficient use of its resources. Now let's go to another term, which is what is working capital? Working capital basically is all short term or current assets like cash, marketable securities, inventories, accounts receivables, and accounts receivables used in operations. So current assets includes cash, inventories, prepaid expenses, and accounts receivables. Now, on the other hand, we learn that current liabilities are short term debt, account payable, accrued liabilities, and deferred revenues. So, if you combine this, current assets minus current liabilities, this is what we call the net working capital, or simply the difference between the current assets and your current liabilities. Now let's jump into the cash conversion cycle topic. Cash conversion cycle is actually the length of time funds is tied up in a working capital, or the length of time between paying for the working capital and collecting cash from the sale of the working capital. Later on, I'll introduce a simple business model for us to better understand what cash conversion cycle is. But cash conversion cycle is actually one of the several measures of management effectiveness. It measures how fast a company can convert cash on hand into even more cash on hand. So let's go into the next discussion. Now, before we continue with our discussion about cash conversion cycle, let me share it with you this simple business model of my friend. So their business is about customization of products. They customizes keychains, mugs, tumblers, and etc. Now their clientele orders the products online, but at the point of order, there's no payment yet. They enter their order and it goes to the manufacturer, and then now the manufacturer orders the supplies from their vendors, and then the vendor sends the supplies to the manufacturer for them to process the product. Now, they pay their vendors upfront because these suppliers, promises them a discount of around 10%, which means they can save on the cost of goods because there's a discount of 10%. Now, from the day that they have received, from the day that they paid the supplier and the day that they receive the goods and then process it, they need at least 10 to 15 days lead time to produce the customized products. After they have customized these products, they then deliver it to the consumers. And this business model is what we call the cash on delivery business model, because the consumers will only pay upon receipt of the customized products, and probably they have some leeway for them to review the product. So from the time they from we consider the delivery time and the receipt of the product, the review of the product, it will take another 10 days for the consumers to make a payment to the business. Now, in total, there will be around 20 to 25 days processing time. I mean, the operating cycle is 20 to 25 days, meaning the cash of the owner is tied up into the business for around this time frame. Although they're earning quite high because the margins are high, they pay the suppliers $1,000 and they are receiving 1,500 from the consumers. But the problem is, for 20 to 25 days, there's shortage of cash. The problem of the owner is, where will they get the funds for their next operation, for their next orders, if the cash is tied up into the business for 20 to 25 days? So this is a type of business model where the conversion of cash from order to to the payments of the consumers are quite long. So now let's go to the next discussion for us to better understand cash conversion. So in a timeline, suppose today you purchase supplies for $1,000. Now it will take you few days for it to be converted into a finished product and eventually convert it into a sales. Let's suppose it's 30 days. In finance, we call this days inventory outstanding. So basically, this is just, it means that this is the average length of time it takes you to convert your supplies into tangible products and eventually converting it into sales. So let's take, for example, 30 days. But the problem is, even after you have converted it to sales, it will take you few days before your customers will pay you. So let's suppose your customers pay you after 15 days. So that's a total of 45 days. So that's what we call days sales outstanding. So basically, it's the average length of time your customers will pay you from the day that you have sold the product. So if you add this together, the days inventory outstanding and days sales outstanding, so basically it's actually what we call operating cycle. It is from the point of time you have paid for your supplies, converted it into a tangible product, selling it, and eventually converting it to cash. So that's what we call operating cycle. The problem now is you have a very lengthy time. Your money is tied up into the business because we are at the assumption that you pay your suppliers on day one and then only getting back your money after 45 days. So basically, that's your money is tied up into the business for 45 days. Now, what if we ask our suppliers that instead of paying upfront, why don't we ask for deferred payment, like we pay them after 15 days? So instead of paying 1,000 on day 0, we pay them 1,000 on the 15th day. So that means that we are decreasing the length of time that our money is tied up into the business. Instead of 45 days, the money is only tied up into the business for 30 days. That's what we call the cash conversion cycle. So the length of time that we need to pay our suppliers from day 0 until 15th day is what we call the days payable outstanding. So when we deduct days payable outstanding from the total operating cycle, the length of time that we produce the supplies into goods and eventually selling is what we call cash conversion cycle. So if we realize now, it's better if each company strives for that cash conversion cycle to be lesser, to be as lower as possible. And there are two ways in improving cash conversion cycle. It's either you decrease your operating cycle by decreasing your days inventory outstanding or days sales outstanding, or you improve or you increase your days payable outstanding. In this way, the time that you need to pay the suppliers, from the time that you need to pay your suppliers and the time that you're getting back your money, will be lesser. Your cash conversion cycle will be lesser. Now let's use this example for us to practice on how to find the cash conversion cycle of a certain company. So we have here our given data: inventories, cost of goods sales, accounts payable, annual sales, and accounts receivable. So in order for us to calculate the cash conversion cycle of a company, we need to first find out what is the days inventory outstanding of the company. We also need to find the days sales outstanding. And lastly, the days payable outstanding. Now, given the above information, we first calculate the days inventory outstanding. And the formula for that is average inventory divided by cost of goods sale times 365 days, because we have 365 days in a year. So given that, the outcome will be 27.14, or 27 days. Roughly 27 to 28 days. Now the next thing that we need to find is the days sales outstanding. Days sales outstanding is the average account receivable divided by sales times 365 days. Given the above information, if you calculate using this formula, the outcome will be 20.19, or 21 days. And lastly, we need to find the days payable outstanding. So to find that, we need the average account payable divided by cost of goods sold times 365 days. Using the above information again, we can then find that the days payable outstanding is around 79.94, or 80 days. So we have the three information now: days inventory outstanding 27 days, days sales outstanding 21 days, and days payable outstanding 80 days. Now the formula for cash conversion cycle will be 27 plus the days sales outstanding, which is 21 days, minus 80 days payable outstanding. The product will be 32, negative 32. That's the cash conversion cycle. Now I found this infographic online about Amazon's cash conversion cycle. Let's take this example for us to better understand cash conversion cycle. So according to their 2019 reports, they have approximately 27 days for them to sell their product, their goods. It sets in it, meaning 27 days to sit in their inventory, and then they sell it. They sell it and collect cash for approximately 21 days, meaning the average number of days to collect money from customers is 21 days. So basically, this is their operating cycle: 27 days plus 21 days, which is around a total of approximately 48 days. So now, if you calculate for their cash conversion cycle, we need to take into account the deferred payment period, which is for their business model. They don't pay their suppliers upfront. They pay them after 80 days. So now the formula for cash conversion cycle is days inventory outstanding, which is the 27 days, plus days sales outstanding, which is the 21 days, minus the deferred payment period, which is 80 days. So basically, they have negative 32 cash conversion cycle. It just means that it's possible to have a negative cash conversion cycle. And what does this mean? Meaning they have 32 days to use cash generated by sales to finance its operations. They're literally using their suppliers' cash to finance their operation, their business. Let's continue our discussion, but this time around, let's learn about the cash budget. What is a cash budget? It's actually an estimation of cash inflows and outflows over a specific period of time, which can be done either weekly, monthly, quarterly, or annually. A company will use a cash budget for them to determine if they have sufficient cash to continue operating over a given time frame. The key here is sufficient cash to continue its operations. Cash budget can be an effective tool that will give a company an insight to their cash needs, whether they need to look for refinancing because they don't have enough cash for that particular period, or use their excess money for investment, for them to earn interest, and for them to have more cash that they can use for their operations. Cash budget can be viewed as a short-term or a long-term cash budget. Short-term cash budgets usually it's a time frame of weeks to months, or a long-term cash budgets which are viewed as years. But the goal is to check if they have enough cash. Now, what are the three important information that we need in order for us to construct a cash budget? Number one, we need to know the firm's minimum desired cash balance. So this is considered a cash buffer. Second is the estimated cash inflows, and third, estimated cash outflows. The firm's minimum desired cash balance is usually considered a cash buffer in order for the company to make sure that they have enough cash. Now, estimated cash inflows. Estimated cash inflows are driven by two main factors. It's the sales forecast and the customer payment patterns. Hence, it is a must that we examine. We need to learn the pattern. We need to have a sales forecast and a customer payment patterns in order for us to construct our estimated cash inflows. Let's say, for example, for this table, the very first row is actually the sales projection. It's the sales forecast for November and December. And then, based on the patterns of payments, collections will normally be 50% of sales of the previous month. So that's 40,000. And the other 50% will normally be paid on the succeeding month, which is January. So that's another 40,000, and so on and so forth. So now we can determine our total cash receipts. Now let's go to estimated cash outflows. Estimated cash outflows is actually the estimated expenses, the projected expenses. So we can also forecast this with the use of our sales forecast. Let's say, for example, for this table, Uh, Materials and supplies purchases will be 50% of the monthly sales. So if our projected sales will be 80,000, our expenses for that month will be half of that, which is 40,000. And for payments will be 100% of purchases of the second previous month. So meaning after 2 months, it will reflect on that particular month. Let's say for the 40,000, it reflected in November. So it will reflect now in January. Now, the other expenses that we can foresee are the salaries and overhead expenses, interest, dividends, taxes, capital expenditures. Now, if we have all of this information, we can then estimate our total cash payments. So we are now ready to come up with the net cash flow because we have our total cash receipts and we also have our total cash payments. We then combine both. So total cash receipts less the total cash payments, we come up with our net cash flow. So let's say for example for January we have 90,000 less our expected expenditures, that's 60,000. So we are left with 30,000 on our net cash flow, and so on and so forth. We can use these three informations now in order for us to construct a cash budget. Now we are ready now to construct our cash budget. Now we start with the net cash flow, the one that we calculated earlier. Then we have our beginning cash balance. This is actually the desired cash balance, which is 25,000, what we call the cash buffer. Then we add it together, that's our cumulative cash balance. So that becomes our ending cash balance as well. Hence, we see that we don't need to source out any other funds because we don't have any deficit. This ending cash balance becomes the beginning cash balance, and then we offset it with the net cash flow. We have a difference of 7,000, negative 7,000. Hence, we need to borrow 32,000, a monthly loan perhaps from the bank, in order for us to reach that minimum 25,000, the cash buffer. And then the 32,000 becomes the first month of our cumulative loan balance. And then when you add that together, we now have the ending cash balance of 25,000. Then that 25,000 becomes the beginning cash balance, and so same process, we need to offset from the net cash flow, and then we have the difference of 16,000. Still not enough. We still need 9,000 more to reach 25,000. Hence, we need to apply for a monthly loan again, and our cumulative loan balance now becomes 41,000. That's 32 plus 9,000, that's 41,000. And our ending cash balance again is 25,000. So meaning our ending cash balance must be 25,000 or more. So example, for the beginning of the month we have 55,000, but for the succeeding months our cash balance must not go lower than 25,000. Now let's go to seasonal versus level production. Under level production, the same amount of raw materials is purchased and the same amount of finished product is manufactured every month, because we project that inventory will build up in anticipation of a higher seasonal sales, while cash and accounts receivable are low that time. When the selling season begins, inventories will fall and receivables will start to rise. After a time, inventories are nearly exhausted and the firm is collecting cash from its customers. Now, for this table below, let's take this for example. It says that there will be the same amount of finished product that will be manufactured every month, and same raw materials is purchased. So if let's say the total forecasted sales is 700,000, 50% of that, which is materials and supplies purchase, is 350,000. So if we take it as a yearly based amount, we divide it by 12, we can then assume that the monthly purchase is 29,200. So that's 50% of the average monthly sales. So every month we'll have that amount: November, December, January, February, March, and April. And for payments, it will be the 100% purchase of the second previous month. So that will be on January. So the 29,000 will start in January, February, March, and April. And so as the other expected expenditures. Now we have our total cash payments. After that, we can then go to the second part, which is to offset the total cash payments from our total cash receipts. And then we have the net cash flow. And of course, we can use the net cash flow as the start of our cash budget. So again, our beginning cash balance is 25,000. That's the minimum desired cash balance of the company. So if you see the cumulative cash balance now, when we use the level approach, is 65,800. There's an increase, and that becomes the beginning cash balance of the next month. Then it was offset by the net cash flow. Now you see, we only need to borrow $400 to meet the 25,000. On the third month, on March, the cumulative cash balance is only 1,800, and we need to borrow 23,200, and that goes back to April. That becomes the beginning balance of April. But if you try to look at the numbers, there's a decrease in cumulative loan balance compared to the previous cash budget that we have prepared. All in all, I can see that there is a better management of cash on this cash budget. Now, what are the things that we have learned today? Let's summarize our learnings for today. First, a cash budget serves as an estimation of cash inflows. It can be done in weekly or even annually. A cash budget is certain if we have enough cash to continue operating, and it also gives us an insight on our cash needs and surpluses. And lastly, we need to maintain its sales expenses to reach an optimal level of cash flow.
I'm happy that you have reached this far, meaning you have watched the entire video and hopefully you have learned something from my presentation from today's discussion. So before we end this presentation, I'd like to have a brief recap of what we have discussed. So we have learned what is the definition of working capital management, what is working capital, and we have dig deeper about cash conversion cycle and cash budget. So cash conversion cycle, again, is the length of time that it takes from the day that you have paid your suppliers until the day that you have received cash from your consumers. So we have learned that the basic method in calculating a cash conversion cycle will be days inventory outstanding plus days sales outstanding minus days payable outstanding, or days period deferred period, payment deferred period. Meaning to say, it's the operating cycle minus the deferred payment period. So that's how you calculate the cash conversion cycle. Now, is it possible to have a negative cash conversion cycle? Yes. Just like our example earlier, Amazon has a negative cash conversion cycle, meaning they're using their suppliers' cash to operate their business, and they can use their own cash to invest into something to earn more and to have more cash for their business. What are the two things that we can do to improve the cash conversion cycle? So again, we can decrease the operating cycle. Second, we can increase the payment deferred period, meaning we can discuss it with our suppliers to make payment arrangements. And that's how Amazon became successful because they are so efficient in arranging this payment deferred payment period with their suppliers. And that's because of their wide array of products. Their variety of products that they sell is so wide that they are able to maintain this wide payment period as well, long payment period. Cash budget. Cash budget is a tool that enables a company to evaluate if they have enough cash to continue operating. And with the use of this, they will also have an insight on their cash needs or if they have surplus of cash. It can be a better or a very good tool for the management to come up with decisions that will help the company. So those are the things that we have learned today. And if you do have any question, don't hesitate to reach out to me or to my partner, Joey Ann. Again, thank you for listening and hopefully you have learned something from today's discussion. Once again, thank you for watching this video until this far. I'm so happy that you have reached the end of this video. Goodbye and have a great day.